Welcome to the Freedom Capital Management Strategies Quarterly Market Review and Outlook. I'm Brian Zabora, Investment Director. I'm here with Pete Murphy, Chief Investment Officer. Pete, third quarter markets started off fairly strong, both stocks and bonds. However, in August and September, we saw the seasonal challenges rear its head again as financial markets sold off. Could you give us a sense of what happened and were there developments or turning points during the quarter?
Absolutely, and thank you, Brian, and thank you all for joining us. As Brian mentioned, investors entered the beginning of the third quarter in a pretty positive state. We saw strong gains in stock markets in the first half of the year, and they carried forward into July with new gains being achieved relatively quickly. And that optimism really sprung from expectations that the Federal Reserve was on the cusp of delivering a historically elusive soft landing for the economy. And what I mean by that is that the Fed has raised interest rates enough to tame inflation, which was very problematic last year for markets, but not so much to tip the economy into recession and to drive unemployment higher. Historically, this has been an unusual set of events, and generally speaking, when the Fed has raised rates like they have over the past year plus, a recession has eventually ensued. But investors began to get more confident that this time may be different, and that led markets to continue their gains in the early part of the third quarter. However, this optimistic tone was challenged not too far after into the months of August and September. And what drove that change in tone is that the economic data coming in reminded investors that while inflation was better than last year, it still was historically high and not quite near where the Fed's target level of 2% is. In addition to that, the economy remained surprisingly resilient and strong. And with those two factors, what it led markets to realize is that their expectations that the soft landing was achieved probably meant that it wasn't quite achieved yet, and the Fed may have some more work ahead of it. And how that transpired in markets was that expectations for interest rates were that the Fed was likely done raising interest rates and likely to cut them pretty meaningfully in 2024. And with the economic data coupled with some hawkish commentary from Federal Reserve members, led markets to reprice those expectations for interest rates, meaning that the Fed may hike rates again this year, and we're likely to be much slower in cutting rates next year and beyond. And that hawkish turn really disrupted the optimistic tone in markets heading into the quarter and led to the broad-based sell-off in stock and bond markets through the rest of the quarter.
Given this shift from general optimism to pessimism in the markets, what is your outlook for the remainder of the year and beyond?
If we take a step back and look at where we are today through the first three quarters of the year, despite a challenging Q3, the U.S. stock market remains firmly in positive territory year to date. And so with that, we look back and say, what are those gains attributable to? And it's our belief that it is the historically pessimistic investor expectations at the beginning of this year that set the stage for the strong returns in the U.S. stock market so far. And what happens is when expectations are set very low, the bar for exceeding them is also set low. And what we've had is a low bar coupled with a surprisingly resilient economy that has been a pretty positive combination for the stock market in particular. But unsurprisingly, as markets began to rise and as this resilient economic data became more front and center of mind for investors, investor expectations also ratcheted up alongside the stock market. And when expectations rise, the bar gets higher and financial markets become more susceptible to negative surprises like the ones I spoke about earlier. And when we look at the state of the economy and financial markets going forward, there remains this important disconnect that we've spoken about in recent quarters, but that remains today. And that disconnect is the current economic data is largely a story of strength and positivity. When we look at measures like a low unemployment rate, strong rate of U.S. consumption, pretty solid economic growth overall, that is a very positive economic backdrop and supportive for financial markets, generally speaking. On the other hand, the disconnect side is more focused on warning signs from leading economic indicators suggesting that risk may lie ahead. And some of those prominent indicators are an inverted yield curve, which has historically been a prevalent recession indicator. In addition, declining leading economic indices, suggesting that economic activity is set to slow. And when we look at the sharp tightening of financial conditions that the Federal Reserve has engineered over the past year and a half, that suggests, based on history, that economic growth is set to slow down. The important question for investors is when. And that remains an open question and is likely going to be a source of continued volatility on both the up and downside in the months and quarters to come.
Pete, we appreciate all those detailed thoughts. Going forward, how do you think investors should position, or how should they handle the current environment?
First and foremost, in an uncertain environment, as I just spoke about, diversification is paramount. And I believe that is the case today, even more so than it's been in quite some time. And the reason for that is that with the rise in interest rates over the past year and a half, bonds and even cash are currently offering attractive yield and total return potential that they haven't for a long, long time. And so with that, I talked about how there's this divergence and disconnect in the economic outlook. This can help in a broadly diversified portfolio because if growth does slow down, historically speaking, bonds and or cash have often offered an important source of ballast for portfolios. Alongside that, we also continue to believe equities and stocks serve an important long-term role in investment portfolios. But within those equity holdings, we encourage investors to focus on resilience. And what I mean by resilience is emphasizing investments in companies with strong balance sheets, steady and growing earning streams, a history of paying and growing dividends. So just more resilient businesses that are better prepared to handle economic uncertainty. And if we do get more positive surprises on the economic data front, the equity holdings and portfolios should really benefit from that type of dynamic. And then finally, it's critically important, as always, to stay engaged with your financial advisor and to make sure that your financial plan remains a living plan.
Pete, thank you for all those great thoughts. Thank you for joining us today. We look forward to updating you in early 2024 with additional market commentary and outlook.
Thank you.